Well, it is 4 o'clock. I want to welcome everyone. I'm sure we'll have maybe a few other people jump on. This is going to be the first session to our 4-part series of maximizing farm profits. So I've lined up some really great speakers for the 4 sessions to provide you with some insight on markets, land values, and ways to secure and protect your farm revenue. So tonight we're going to have Dr. Michael Langemeier with us, and he is the Associate Director for Center for Commercial Agriculture at Purdue and also an Ag Econ professor. And he's going to talk with us a little bit about market outlooks, net return prospects, and the Ag Econ Barometer. So I'm going to go ahead and let him start in.
Thanks, Stephanie. Good afternoon. I'm joining you from sunny Lafayette with no rain in sight. Hopefully it will rain in the next few days, but it doesn't look real hopeful right now for this part of the state. Let me go ahead and give an outline of what I want to talk about today. I'm going to talk a few minutes about each of these topics. I'll try to keep it brief on a couple of these topics because I do want to get to the end where I actually talk about net returns and government payments, and then end up talking about the implication for my net return projections on cash rents and land values. Stephanie is recording this, and so if you do have to step away from your computer, this is recorded, and you can catch up later after she sends the link. I'm sure she'll send the link after this webinar. So I'll start with the Ag Economy Barometer. That's the sentiment index that we do on a monthly basis. Just show you what people across the Corn Belt and Plains are thinking about in terms of the current environment. They're obviously not very optimistic, but I'll share that information with you. And then I'll talk about expected crop prices, talk about the corn and soybean balance sheet. As of mid-June, the WASDE report came out about a week ago, and so I will share some of that with you. It's not real optimistic, but nevertheless, I will share that information with you. It's not too optimistic from the supply side for corn. The demand is actually quite strong. And so if anything happens to the supply of corn, either we didn't plant as many acres as we thought we were going to. According to the March Planting Intention Report, there'll be an update on the acreage estimates coming out later this month. And so if we didn't plant 97 million acres of corn, that will strengthen corn prices because demand is relatively strong. Also, if we don't hit trend yields, there's some dry spots across the Great Plains and the Corn Belt, and it seems like it's getting drier. And so if we don't hit trend yields, that'll also have an impact on corn prices. And so even though the corn price outlook is not very optimistic, there is strong demand there, which I think is important to note. I'll use the prices that I talk about in the balance sheet to come up with some net return projections and share some information related to government payments for a case farm in West Central Indiana. And then I'll finish up by talking about cash rents and land values. And so let's start with the Ag Economy Barometer. Just remember that this is a monthly survey of 400 U.S. agriculture producers. We focus on the major crop and livestock enterprises. We do not survey tree nuts or vegetable producers, and so it's primarily corn and soybeans and wheat, but we also have a pretty significant percentage of beef producers in this survey. And so just keep that in mind as I go through the slides. Each of the respondents does have a value of farm production greater than 500,000. The reason why this is important is all of these respondents, for the most part, are full-time operators. That makes a lot of difference. If we would survey part-time versus full-time operators, these are full-time operators where farming is their primary source of income. We do not survey the same people every month, but the characteristics of the people we survey are held constant from month to month. And so that gives us some validity to compare the results from month to month. Looking at the last question, the survey, this is the May results. We're going to be sending out the June survey next Monday. So all of next week we'll be conducting the June survey, and then we summarizing that in early July. But in terms of May, we on the open-ended question at the end of the survey, we ask people what's on their mind, and there's a lot of things on their mind. When we've done this, when we did this from early 2018 into early 2020, trade was by far the biggest word on this word cloud. Trade is still on people's mind, but there's a lot of other things on people's mind. packers, prices, ethanol, COVID-19, cattle, livestock, regulation, income. And so all of these things, create a situation where where individual sentiment is not real high. And this chart right here shows that after reaching a peak of 168 earlier this year, once the COVID-19 started impacting all of production agriculture and the entire U.S. economy and the world economy for that matter, the sentiment dropped very sharply. We did have a little rebound in May compared to April, and so April was the low, but certainly sentiment is much lower than what it was pre-COVID-19. You've been paying attention to prices, like I'm sure you have. Prices for most agriculture commodities are down and down rather sharply, particularly corn. If you're looking at the crops, soybeans is down rather, quite a bit too, but not as much as corn. And it certainly had a large impact on the cattle industry, the dairy industry, and the pork industry. So looking at breaking this up into indices of current conditions and indices of future expectations, the index of current conditions right now is quite a bit below what the index of future expectations is. What this tells us is people are more concerned about the current situation, the next year, than they are 3 to 5 years out. We have questions that make up the primary index, 5 questions, and a couple of those questions are related to current conditions. The other questions related to future expectations. And so this is not real shocking. Most people think that COVID-19 is going to have a pretty big impact on 2020, but I'm not going to say that 2021 is going to be a banner year. If it's going to be back to normal, that's not necessarily the case. But nevertheless, people do expect things to improve as we move into 2021. And so that's what this chart is reflecting. No big surprise there. Another way to capture that, and this is actually one of the questions that make up the 5 questions that go in the Ag Economy Barometer Index, the Farm Capital Investment Index is still well below 100, which means that more people think this is a bad time to invest in machinery and buildings. No surprise there, than think it's a good time. That's what under 100 means. We've never seen a situation where it was over 100 during the life of this Ag Economy Barometer, but it did rebound a little bit from April, but still quite pessimistic, and no surprise there. With the working capital situation we're going to be seeing later this year, there's not going to be a lot of money for farm machinery and buildings. People are probably going to be more focused on repaying debt. Another chart that I like to show in presentations like this is to look at the relative pessimism or bullishness versus bearishness for corn and soybeans. And if obviously if the bar is below 0, that means people are on average bearish. If it's above 0, it's bullish. This just shows you how bearish people really are when it comes to corn and soybeans, particularly corn. Before COVID-19 hit, we actually had some bullishness with respect to corn. And this is very important to think about, because the March planting intentions took place, that survey took place really before COVID-19 hit. And so the fact that we had 97 million acres of corn and 83.5 million acres of soybeans coming out of that survey means, and then we combine that with this particular chart, we think there probably is going to be some switching away from corn from that March intentions report. We talked about this in a recent webinar, but let me reiterate the importance of this chart and those planning intentions. This chart basically provides our rationale for why we think there's going to be 1 to 2 million acres less corn that was in that planning intention report, and 1 to 2 million acres more soybeans. It's because there is a lot more bearishness with respect to corn in mid-March on compared to before that. And even though there's probably not going to be a lot of switch in acreage because you're getting fairly close to planting, there'll be at least some because corn is we're certainly more bearish with respect to corn than what we were earlier this year. That doesn't mean we're bullish with respect to soybeans. but we're less bearish with soybeans than we are with corn. Looking at a chart related to financial performance, no surprise here again. In December, there was quite a few people thought that their financial performance in the next year was going to be worse, 30%. That's the brown bar on 12/19. That's increased rather dramatically after COVID-19. So now we have a situation where over 50% of the farms in this survey expect financial performance to be worse. And I think that will be the case for a lot of farms in Indiana having worse financial performance in 2020 compared to 2019. And I'll show that I'll show the net returns for a case farm later in this presentation to kind of illustrate what 2020 looks like compared to 2018 and 2019. One other a chart here I want to share with you with respect to the May results. In May, 70% or 71% of the producers surveyed were either fairly worried or very worried about COVID-19 impact on profitability. I'm a little surprised that wasn't even higher than that. But that I think that it would be higher if you just looked at the Eastern Corn Belt. Wheat is not as pessimistic after COVID-19 as some of the other commodities, and so perhaps in the Great Plains, people are a little less worried about this than we are in the Eastern Corn Belt. But nevertheless, just reflecting the fact that this has COVID-19 had very widespread impact on profitability prospects for 2020. Just quantifying that. So now let's talk about expected crop prices. Expected crop prices are quite a bit lower than what we thought they were going to be heading into March because of the COVID-19. So let's try to quantify that. Before I do that, I do want to show a long-term chart looking at corn, soybean, and wheat acres. As we expected, corn acres and soybean acres increased quite a bit from 2019, particularly soybeans, because essentially what happened, the prevent plant was essentially split. Part of the prevent plant from 2019 went to corn. Part of the prevent plant for 2019 went to soybeans, and that was similar to what we expected. Wheat continues to decline, and you can see the long-term trend in wheat is downward. The U.S. is not near as competitive with respect to wheat as we are with corn and soybeans, and so we continue to produce a lot of corn and soybeans compared to wheat. I don't see that changing anytime soon. I'm part of a national benchmarking group, an international benchmarking group, and Russia and Ukraine are very, very competitive with respect to wheat. They're gaining competitiveness with respect to corn. And so I think that the wheat acres in the U.S. are going to continue to be relatively low. And the reason I'm talking about this in corn and soybean country, that pushes more acreage into corn and soybeans. There just isn't real good options for people that have corn and soybeans. And so we put acres in corn and soybeans, even though the return prospects, particularly for corn, are not very good for 2020. But right now we have, according to the March planting intentions, 97 million acres of corn and 83.5 million acres of soybeans. Again, we're expecting at Purdue here, Jim Minter and myself, approximately 1 to 2 million acres less corn than what was in the planting intentions in March, and that 1 to 2 million acres going to soybeans. And I'll talk about what that might mean for the corn and soybean balance sheets. So let's look at the corn balance sheet next. And I know there's a lot of numbers on here, but bear with me. I'll try to summarize this. So right now, 97 million acres of corn, and that is coming from the March planting intention. USDA does not change that forecast until they get the June 30th crop production survey results. And those will come out in early July. Once that happens, we will revise this balance sheet. Our next webinar, July 13th, we'll have the revised planted acres in that webinar. And we'll talk about what that means for price. But let's just use the numbers that we have right now. Planted acres of 97 million and a yield of 178.5. That's trend yield. Very impressive. Trend yield's been going up 2 bushels per year for a long time. not just the last 20 years. You go back to 73 at least, and you'll see 2 bushels per year. You like clockwork, if you will. The beginning stocks were relatively lower than the beginning stocks from 1920. But what's really happening with this balance sheet is the very big increase in production. More acres were planted because we don't have as much prevent plant this year. Yield is higher because the weather is, at least we think it's going to be more cooperative. That's yet to be determined. But looking right now, it looks like the yield is going to be higher, quite a bit higher than what it was last year. That creates a situation where supply is 2.4 billion bushels more in 2021 compared to 1920. That is why price went from 360 to 320. I do want to point out that demand is strong. If you look at feed and residual, demand is higher in 2021 because we're feeding a lot of animals, and we've got very large production of beef, poultry, and pork this year, and that's creating a very strong feed demand. This feed demand's the highest it's been since 2005. So we're using the most corn that we've used since 2005 for feed and residual. So very strong demand from a feed standpoint. Ethanol is up from the previous year. I don't have the balance sheets for 17 and 18 here, but that 5.2 billion bushels is lower than what we had in the previous 2 years that are not shown here. And so even though it's higher this year, it's not as high as what it was 2 years ago, but still strong, relatively strong demand compared to 1920. Obviously, the 4.9 billion bushel for 1920, what's going on with that number? Well, COVID-19 had a huge impact a negative impact on fuel demand, and that's reflected in the ethanol of 4.9 billion bushels. That's the lowest we've been in several years, and like I said, it's quite a bit lower than what we saw in 17, 18, and 18, 19 marketing years. But nevertheless, the 2021 number is higher, and perhaps we can go a little higher than that 5.2 billion bushels. We'll have to watch that as it goes. Also, USDA is expecting exports to be up for corn, about 375 million bushels, so that's certainly a good sign. But as I said before, when I started talking about this slide, the large supply is putting a damper on prices. And I just don't see this changing very much unless the acreage is much smaller than what we thought it was going to be, and we have a reduction in yield. And certainly a reduction in yield is not something we want to see here because the net returns are low enough to begin with without having a reduction in yield. So that's the corn balance sheet. Let's go to the soybean balance sheet. One other point on this one. Notice the stocks to use ratio is increasing from 15.3% to 22.5%. That 22.5% is one of the largest stocks to use that we've seen for several years. And so it's just summarizing the large impact on the increase in supply on stocks to use, and that's translating into a 40-cent reduction in average market price for 1920 and 2021. Now remember, this 360 for 1920 and 320 for 2021, they're going to be used to calculate ARC County and PLC payments. We use the U.S. marketing year average prices. Both of those are still estimates and a forecast because 19 and 20, the marketing year does not end until the end of August. 2021, that is a forecast because we don't even start that marketing year until September. And so those numbers could change a little bit. The 360, I'm not expecting to change very much, but that 320 could change. It could easily be 20 cents lower or a dime or 20 cents higher depending on acreage and yield and these other demand factors. Looking at the soybean balance sheet, this is a different critter altogether. We increased acreage and we're expected to increase yield going to the trend yield of 49.8. That obviously could change as we proceed through the growing season. And as I indicated a couple different times now, the planted acreage probably is going to be higher than that in the June 30th survey. And so we're going to have a little higher supply. But what's going on here is even though the supply is higher in 2021 or forecast to be higher, we were dealing with some pretty low beginning stocks. because we reduced soybean acreage so much in 2019. Basically, corn was more profitable than soybeans in 2019, particularly for the Western Corn Belt. We saw a large reduction in soybean acres. That really brought the stocks to use down. And so we started the year with fairly low stocks in terms of soybeans. We add to that some higher production. Looking at the demand side, the crush is expected to be similar to this year compared to last year. The exports are expected to be higher. We've been hearing good news from China. Hopefully that will continue. These exports at 2.05 billion bushels, they're still not as high as the export numbers in the previous 2 years that are not shown here, but they're getting closer. And so as Jim and I said in the webinar, we think that 2.05 might be a little optimistic, but let's hope that comes to fruition, because if that comes to fruition, that's certainly going to create a situation where use is going to exceed supply, or use is going to exceed production rather, and that brings ending stocks down to below 10% if this balance sheet pans out. Now, if we have 1 million or 2 million more acres, that stocks to use is going to increase over 10%. That's kind of a magic number when we're looking at stocks to use, looking at possible spikes in prices. That could easily go to 10 to 11%. I'm thinking probably close to 11% when this balance sheet is revised in July. But nevertheless, that is a drop in stocks to use from 1920 compared to 2021, exactly opposite of what's been going on with corn. And so one of the things that's been happening in the last few months is soybean profitability relative to corn profitability has been increasing dramatically. And so I'll show you a chart on this in a little bit, but I'm expecting soybeans to be considerably more profitable than corn using these two balance sheets, despite the fact that the marketing year average price for soybeans is lower than it was last year. We're just taking more out of price for corn than we have soybeans. And so soybeans, even though they're not great returns, they look better than corn. Looking at marketing year averages, I know this is kind of a boring slide, but just to put in perspective what that 320 means, this is lower than what we saw in 16, 17, 17, 18, where corn was not very profitable compared to soybeans. Soybean price is also down quite a bit from what it was, particularly in 16, 17, and 17, 18, but it's not down as much as corn, and so this just puts that in perspective. Looking at futures price going back to early 2018, July 12th was the peak last year. That was right before the crop production report. So we peaked at 440. The production report last year, June 30th production report last year, showed much higher acreage than we anticipated, and so corn prices plummeted. Corn prices were relatively strong in late January of this year at 383. They tumbled, but they've come back a little bit in the last 3 to 4 weeks. And so right now the nearby future, the last weekly average was 330, a little higher than what it was just 3 or 4 weeks ago. But the main reason I'm showing you this is corn is still down 50 cents. Compared to what it was in late January. Obviously, that is a huge impact on profit prospects for corn. Looking at soybeans, soybeans is different in terms of its trend. The big drop in soybeans took place as we entered the trade war with China in mid 2018, and so we went from over $10 down to $8.50 or slightly lower than $8.50. In January of this year, last July 12th, we were at 890 soybeans. Corn looked very profitable compared to soybeans last year, and particularly last summer. That's changed completely. In January 31, soybeans were about 887. Corn still looked good from a profit perspective, at least even with soybeans in late January. Oh, how things changed. The last weekly average we have for soybeans is 857. We have seen a little bit of strength in soybeans recently, but we're still down 30 cents from the January number. So soybeans down 30 cents, corn down 50 cents, and so this is just illustrating how much corn profitability has taken a hit, because corn prices have dropped quite a bit more than soybean prices. Let's review a little bit why corn prices dropped before we continue here. Remember, back to the balance sheet, we've been struggling a little bit with ethanol demand. It looks like it's going to be higher in 2021, but we're still below where we were 2-3 years ago, and so that certainly had an impact. And then the extremely large supply we're expecting for corn is also having a negative impact on corn prices. I like to use the iFarm price distribution tool to look at prices for the upcoming crop year, and so this is accessible. Just type in iFarm price distribution tool in your search engine, and it'll pop up a tool that will give you information like this. And so I'm looking at is fall 2020 prices, December corn futures, and November soybean futures. And the 50% is approximately what the futures price is telling us. If you look at the agweb.com or other places to look at future prices, you're going to see for December approximately 340 corn and approximately 870 soybeans. So that's what the 50% means. The reason I like to use this, if you're doing contingency planning or you're doing what if in a spreadsheet looking at cash flow for this year, you don't want to just use the expected price, which is the 50%. You want to look at a relatively low price and relatively high price. And so I typically use the 25 percentile, which means that there's a 25% that corn futures could be below 304. Ouch. And we're also returning to more of a normal basis in the fall, and so that translates into about 280 corn, cash corn. If the 25 percentile, again, there's only 25% of prices being below that, but still, that's still 25% chance that corn could be below 280 is what that's telling us. On the soybean side, 25 percentile is 814. If we return to more of a normal basis or a long-term basis for soybeans, which appears that's what we're going to be doing here for the new crop, that would translate into 780 soybeans. And so 25% chance of soybeans being below 780. On the high side, there's 25% chance of corn, this is futures, being above 375 and soybeans being above 930. This is not a bad time to think about maybe selling some corn or soybeans if you have old crop, which I'm assuming quite a few people still do. I'm not saying you need to sell today necessarily, but as you start getting into mid to late July, it becomes much more risky, much more volatile price environment for old crop, because new crop is going to start impacting. What's happening with the new crop is going to start impacting futures prices November and December later this year, and so it just becomes more risky. And so look for pricing opportunities if you still have old crop in the next 2 to 3 weeks. Now let's translate these prices into net return projections. And so I'll come full circle here, use some of the information in the corn and soybean balance sheet, use some of the price information I've just went over to look at net returns for corn and soybeans for a case farm in West Central Indiana. I want to make sure everybody understands the definitions here, and as I indicated, Stephanie is recording this, and so you'll have these slides. So that's why I have this definition slide. So if you take a look at this later, you know what I'm trying to present in the following slides. Net farm income is the income that we see in an accrual income statement. So it's gross revenue, so revenue adjusted for inventory changes, minus cash expenses and depreciation. It excludes operating family labor, which is typically an opportunity cost, and then opportunity costs on machinery, buildings, and land. And so if you own land, there's not a charge for land when we're calculating net farm income. Obviously, it would include cash rent in there because that's a cash expense, and also non-family labor is a cash expense, so it'd also be included. So think of this as a residual that's used to pay operator family labor and to cover some of the some of the fixed costs, if you will, on owned machinery and grain bins and land. Net return to land includes these opportunity costs, except for land. And so I use net return to land to compare to cash rent. If net return to land is relatively low compared to cash rent, which it is for 2020, that means there's some downward pressure on cash rent moving into 2021. So this is looking at, for a case farm, looking at, you're looking at net farm income sources. I've got government payments, that's the checkered bar. Crop insurance is the green bar. That was important for a couple years for this case farm, 12 and 15 specifically. Crop net returns, and then combining all that into net farm income. First of all, 2020 looks very similar to 2015 for this case farm. 2015 was a very wet year for this part of Indiana, particularly June was extremely wet. That translated into some low yields, and so that's why 2015, in addition to relatively low prices, that's why 2015 looks pretty bad there. But 2020 is going to give it a run for the money. And so what I'm showing you here is even with the expected Ark County PLC payments, which I'll show you on an upcoming slide here, and the CFAP payments expected this year, we're still looking at a really low net farm income. And so hopefully there'll be some additional government payments coming down the pike here later this year, and hopefully prices will be higher than what I showed you earlier. But when you start talking corn, close to $3, you're looking at some very low returns, and that's what this is clearly showing. The government payments in 2020, even though they're relatively large, they're still not as big as what they were in 2018 or 2019 in particular, and then 2015, where we had some pretty big Ark County payments in 2015, particularly for corn. And so that's what that is showing. Looking at the corn versus soybean profitability, I kind of set this up by talking about the respective balance sheets for corn and soybeans. Corn was more profitable in 2019. And I thought we had turned a corner where corn and soybeans were going to have similar profitability for the foreseeable future. And so if you heard me talk this winter about this particular chart, I expected that 2020 would be very close to zero, very similar profitability for corn versus soybeans. That's not the case. With the 50-cent drop in corn prices and the smaller drop in soybean prices, the balance sheet just looks better for soybeans right now. I think soybeans are going to be considerably more profitable. My current estimate is about $100 more profit for soybeans compared to corn. This is using trend corn yields and trend soybean yields. If for some reason corn would bust through that trend, that $100 would not be would be something smaller than that. But right now, soybeans are looking similar to 17, 18 in terms of profitability, profitability and potential. Let's look at government payments for the last 3 years. When you look at 2018, the Ark County PLC payment was zero. We received our payments in the 2014 Farm Bill primarily for 14, 15, and some in 16, 17, and 18. We did not get an Ark County or PLC payment. If you look at corn, soybeans together, the MFP payment was about $52. Most of that was paid to soybean, but here I'm averaging them and looking at a corn soybean rotation. So soybeans was about $100 and corn was very small. Average those two together, MFP payment at $52 per acre for this case farm in West Central Indiana. A little higher in some other Indiana counties, but also a little lower in other Indiana counties. So this is about an average. Looking at 2019. This is still projected because we have to wait to the end of August to finalize the corn and soybean price that's in the balance sheets I reported earlier. Right now we're looking at $360 corn and $850 soybeans. With those prices and assuming that we went Ark County for soybeans and PLC for corn, we're looking at an average payment for the two of about $20. Most of that right now is coming for soybeans. So Ark County on soybeans, with the 360, that's just a dime below the 370 reference price. So small PLC payment for corn is expected in 2019. Average those two together, and we get $20. The MFP payment was pretty strong in 2019, $62, and it was similar for corn and soybeans. We averaged them together, $62, and so $82 worth of government payments in 2019 compared to $52 in 2018. Looking at 2020, I've already included these in the charts I've talked about earlier, but they are sizable, and even with these sizable payments, we're still looking at a negative net farm income. Ark County and PLC, because of the low corn price in particular, we're looking at some pretty strong payments with the corn payment being quite a bit higher than the soybean payment. Average the two together, and we're looking at $40. That's my current estimate for White County. This is going to vary a little bit across Indiana, particularly because of the Ark County for soybeans is going to vary across Indiana. The PLC would be the same or very similar because remember the PLC is based on your base yield, which is called a lot of times PLC base yield, and that is farm specific. And so the PLC payment could be a little different as you across farms, cross county lines. But I think this captures what's going on. The CFAP payment, even though these are good payments, pretty strong payments, it still only amounts to about $21 per acre. You combine those two and you've got $61, a little higher than 2018, but a little lower than 2019 in terms of government payments. So now let's combine the net returns I talked about and look at what might happen to cash rents and land values. So let's review a little bit some factors that impact cash rents and land values. Cash rents are largely driven by net return to land, and so that's farm revenue minus all expenses except for land. And so opportunity costs are included here. We have family and operator labor subtracted to get net return to land. We have an opportunity cost of machinery, grain bins, buildings, everything except for land is we have an opportunity cost and on all the cash costs included, including depreciation. So those are included to get the net return to land. And so we can directly compare that to cash rents and see what the trend might be for cash rents. Land values, cash rents are important. However, these other factors are also important. I'm going to talk about each of these in turn a little bit. Interest rates, inflation, supply of land, and investment potential are all important. So it's no surprise here. I'm going to show you a diagram. I'm going to show you a figure on this, but net return to land is very low compared to cash rent for 2020. In fact, the diagram I'm going to show you, net return to land is over $100 lower than cash rent for 2020. That means downward pressure on cash rents. Similar to the situation we were in 2015, which in 2016 we had a fairly large reduction in cash rent in response to that low net return to land in 2015. There's usually a one-year lag there. If net return to land in 2020 is low, that translates into lower 2021 cash rents. So usually a one-year lag there. Cash rent, if cash rents are lower, or there's downward pressure on cash rents, that is has a negative impact on land values. However, all these other factors are positive when you look at land values. Interest rates are extremely low, and I think they're going to stay there for the foreseeable future. We could even have negative interest rates, going into next year, just depending on what the economy does. But even if they're not negative, they're going to be really low. So if you have money in a market in some kind of a savings account, you're not going to get very good interest rates. That's just where we're at today with interest rates. That's positive on land values, positive on the stock market. Anything that's an asset, low interest rates increases the value. House prices, commercial real estate, all of these things are being positively impacted by low interest rates. Inflation, we're not expecting inflation to necessarily increase. However, recent Federal Reserve policies certainly do have some inflationary pressure. Inflationary pressure is is there because of recent Federal Reserve policies. Specifically, they've increased their balance sheet rather dramatically. Depending on how that's unwound, it could be inflationary. Why am I talking about that? Land is an extremely good hedge against inflation. In some research we've been doing at Purdue, it's better than gold in terms of a hedge against inflation. So if we have a lot of inflation, you're going to see institutional investment money go to land, emphasize land. The supply of land right now is very low. It's a thin market to begin with, but anecdotal evidence suggests that the supply is particularly low right now. That's positive for land values. The investment potential, there's quite a bit of interest from institutional investors, particularly in the Eastern Corn Belt. And the reason, there's good reasons for that. Land rates of return on land are not correlated with the stock market. And from an investor standpoint, that's very positive. They like to combine assets that are not where the returns are not highly correlated or don't move together. That means if the stock market's high and if the stock market's low, is probably the best example. If the stock market's low, land may not be low, and we saw that a lot from that during that 2008 recession. Land values kept increasing. 2007, 2008, they were fairly flat in 2009, higher in 2010, whereas stocks were not doing very well. So that makes farmland relatively attractive to institutional investors. The reason why I emphasize institutional investors, it almost has to be a pension company or something like that to be interested in land, because land is not something you want to buy and sell all the time. There's huge transaction costs, or there are transaction costs associated with land. They're larger than transaction costs associated with some other assets. And so this is primarily interest from people that are going to hold land for a long period of time. TIAA-CREF is a very large pension company for colleges. Many universities have used TIAA-CREF as their pension company. University of Illinois, for example, does. We used to here at Purdue, but now we're using Fidelity. But TIAA-CREF has a lot of money invested in land because they plan on buying it and then holding it for quite some time. So the investment potential right now is also creates some interest in land, and so I think we're in an environment. We'll see what Howard Holderman says on Thursday in this series. But I think we're in an environment where there's downward pressure on cash rents, but not necessarily downward pressure on land values, because even though cash rents are not real positive right now, rent return to land's not very positive from a land value perspective. Some of these other things are positive, and so we could be in a situation where cash rents could decline at least somewhat in 2021. I'm not talking crash here. I'm talking, down maybe 1% or 2, 1 to 5%, maybe, with the emphasis on the lower percents. But land values may not decline at all, because we have these other factors that are positive, particularly interest rates. I can't emphasize enough the impact of those low interest rates. So this is the chart I was talking about in the previous slide. We see this larger than $100 difference between net return to land in 2020 and cash rent in 2021. That's large. And so I think that's going to create a situation where we're going to see some downward pressure on cash rent. Eventually these two have to equal. And if you looked at the 2007 period to 2020, they'd come very close to equaling. But you simply can't have a year like 2020 followed by a year in 2021 that looks about the same and not expect to have some downward pressure on cash rent. And so that's where I'm coming from when I say there's some downward pressure on cash rent. And I talked about the decline in 2015. For West Central Indiana, we had a decline in 2015. I believe that was 7 or 8%. That's a little higher than what I would think we'd have for 2021, but like I said, anything up to 5%, is certainly possible given where we're at with net return to land right now. One of the things we did in the Ag Economy Barometer survey recently that you might find interesting is we asked the people whether because of this reduced returns in COVID-19, you plan on renegotiating cash rents next year. And I don't know if this result's surprising or not, but close to 30% said that they said yes to that question, that they're planning on renegotiating cash rents in light of what's happened with the decline in prices, particularly corn. So just food for thought there. That just confirms my my discussion of downward pressure on cash rents. I would like to talk about a couple other Ag Economy Barometer charts that I think you'll find interesting. Here's farmland price expectations 12 months ahead. We do this every single month, and so we'll have this updated in early July for the June survey. But people have been pretty pessimistic, not real surprisingly, in April and May of this year after prices dropped quite a bit. Quite a few people are expecting lower farmland prices. More people are expecting lower than higher. But I think they're being a little too pessimistic here. That's my 2 cents on this. I'm of the opinion that I think land prices are going to be relatively stable. And actually the majority opinion, if you look at 520 and you take the 8% and add to that 29%, that's 37% of the people. The other 63% said land values are going to be flat. And so that's where I stand looking at farmland prices 12 months ahead, is I think we're looking at fairly flat farmland prices for the next 12 months. That's certainly good news if you own land and you're using that owned land as collateral for loans. You certainly would not want to see large drops in land prices because that's going to negatively impact your collateral. Looking ahead, people are still fairly optimistic with respect to farmland. This is not surprising to me at all. As I've said many times before, if you look at any 5-year average of farmland returns going back all the way to 1960, there's only a couple periods during that very long 60-year period where farmland prices did not increase for any 5-year period. There was a period in the 1980s where they declined rather sharply, and then there was a period recently where land prices were slightly negative. Going from 14 to 19 or 20 in that period. Farmland prices were slightly negative during that period. But all the other periods we look at, farmland prices increased, and so that's consistent with this right here. A large percentage of the people think that farmland price expectations will be higher 5 years from now. I'll just tell you where I stand on this. I'm definitely in the higher farmland prices. Not double digit, but I do think that we're in this situation because of low interest rates and interest from institutional investors and some other factors where we're going to see stable to slightly higher land prices for the next 5 years. Might not necessarily the next year or two, but looking 5 years out, I think you're seeing stable to slightly higher farmland prices. So that's what I wanted to discuss today. You can contact me directly. My contact information is on the Commercial Ag website, so you can contact me directly and ask questions, or you can ask questions through Stephanie, and I can get back to Stephanie. So however you want to do that. Let me just briefly summarize what I talked about today. I wanted to show you the Ag Economy Barometer. If you're relatively pessimistic right now because of the low corn prices and soybean prices, you're not the only one. That's pretty much the general feel of the agriculture community right now. And I showed that with the Ag Economy Barometer. For those that might be in the lending business out there, I also showed you that there's not going to be a lot of demand for purchasing machinery and buildings later this year. No big surprise there, but that certainly came out in the Ag Economy Barometer survey. I also showed the extreme pessimism regarding corn prices in particular, but also soybean prices. Also talked about the balance sheet for corn and soybeans, looking at a drop in corn price in particular, but also a drop in soybean price for 2021 marketing year compared to the 1920 marketing year. We combined that with yield expectations, and we saw a relatively large drop in net return to land for 2020 compared to 2019. I didn't show you the chart for 21, but in 21, assuming that there's no MFP or CFAP payment or something like that, 2021 net return also does not look real good, and that translates into downward pressure on cash rent for at least the next year or two. But having said that, as I've said many times here in the last few slides, even with the downward pressure on cash rent, I don't think there's as much downward pressure on land values. So with that, I will turn it back over to Stephanie.
Oh, I was muted and talking. Thank you very much, Dr. Langemeier. Does anyone have any quick questions for him right now that maybe if anyone has one or two questions, we might be able to answer those?
There's a chat box down there.
And like Dr. Langemeier said, if you guys do have questions later, feel free to reach out to either of us and we can chat with you more. But thank you all again for joining in this evening. I hope you enjoyed it. You should be receiving a survey in your email here in a few minutes. And so I'd really appreciate if you would answer those. I think it's 4 or 5 questions, so pretty short. But thank you again, and I hope to see you all back on Thursday evening, same time, same place, and we will hear from Howard Holderman at Holderman Real Estate and Farm Management. So with that, we will wrap up, and thank you all for joining.